Just a quick question here on a previous video we did, or the prior video we did for today, asking if we do see an opportunity for fast money moves in something like equities, how we can look to enter these moves. Now, it's like any other instrument, whether it's currencies, whether it's commodities, whether it's equities. Um, it's all going to be the same. Obviously, at market, if you're quick enough, it's normally going to give you a good entry. So let's quickly look at the S&P 500 today and just get an idea of this. So we're already seeing some downside across the board. Most importantly, we are now well below that high point going back to Thursday session. So from a purely technical point of view, this does put us in a more bearish vibe. But obviously, the overall sentiment currently driving this market is the negative virus numbers coming out. So how we can look to possibly trade something like this. Currently, we're waiting for any additional numbers to come out in terms of the increased cases. Now, let's drop down to the 1 minute time frame and see how we can look at this. So if we just quickly remove our S1 and R1 just to get some more space on the screen. Now, where the market is currently trading, obviously we're waiting for that increased data. The one thing that you don't want to do is you don't want to enter at a compromised position right here so close to the lows. Now, that might mean that you might miss some trades sometimes. You can see the market basically just accelerating to the downside from here. But why risk entering at such a compromised position? Now, what you could also do is we can see on this chart, we had that spike low coming down in yesterday's session, testing the 31.25. We also coincided that with these low points from today. So if we just quickly extend that oval area across the charts like so, that gives you a much more attractive area to re-engage this market to the downside with. Basically giving you a nice pullback. So if you do enter from this oval area, you can have a nice tight stop just above these recent swings, above that very important support and resistance area. So that gives you a possible entry zone to consider if and when you get that next negative catalyst to trade from. Of course, if you're close to this zone and the number breaks, that's perfect. If you're above that and even a break above that level, then again, it gets a little bit more tricky because now you're tilting from a technical point of view, you're tilting slightly more bullish again. But that's one thing that you can do. I mean, personally, for me, I would never look to, even though we've had some negative numbers coming out now, obviously in terms of Florida with 9,000 additional cases, up 5.6%. That's negative. We saw that fast money move down, but you can see the market's already retracing that. So never, as long as it's possible, always try to not enter at a compromised position very close to the lows. You don't want to be selling at the lows, and you don't want to be buying at the highs, right? So in this type of environment, if you miss that first initial move, just wait for the next catalyst. If you do get a next negative catalyst and you're close to that area, you can use this overall zone as a possible opportunity to re-engage the market from to the downside. So that's one way that you can look to re-engage a market like this. But really, it's there's no secret sauce. This chart could have been the Aussie US dollar. It could have been the Euro US dollar. It could have been WTI. It could have been any other instrument out there. It's really not. There's no secret sauce. In terms of the difference between trading equities and trading currencies, all use the same type of structure. Never looking to sell at the highs, never looking to buy at the or looking to sell at the lows, and never looking to buy at the highs. I think is a golden rule to always remember. So in this particular example, for today, find those high probability areas on the chart where you think it gives you a better opportunity to re-engage the market with. And the question that's often asked with this type of example, what if the news breaks and we know we're close to this area? What if we get bad news and we're at the lows? I mean, there you'll need to use your own discretion, right? So do you think the news that comes out is negative enough to continue pushing the markets lower? Obviously, if you have a look at some of your other technical areas, again, you have that spike high going back 2 sessions as well. So you're not too far away from that zone either. So do you really want to be selling right at the low, so close to that next support area? Probably not. So that still makes that overall zone up here as the highest probability opportunity in terms of risk reward to look for some re-engagement on the chart. So that's just a quick tip that you can use for finding some potential entries in something like equities when you're expecting fast money moves to the up or to the downside.